Welcome back to another Millennial in Debt video. If you are not subscribed here, don't forget to hit the subscription button down below and turn on the notifications so you get every single time I upload a video. So we are on Stock Tip Tuesday number 4, okay? And all good things come to an end, but we have not reached the end just yet. We have got 3 more weeks or 3 more Stock Tip Tuesday videos before I bring this series to a close. So if you have enjoyed this series or if there are other things you want me to cover, feel free to leave it in the comments below or send me a DM on Instagram. If you're not following on Instagram, make sure you follow on Instagram. It's a really fun, good time over there. Trust me, I would know. Okay, so today what we're going to do is we're going to go back a few steps. I know we've been talking about mutual funds, index funds, stock market apps, all these things for investing. But what do all these terms mean exactly? What is it that I'm talking about? So today we're doing a vocabulary lesson. So we're going to talk about the ins and outs, beginner-friendly information, the ABCs of the stock market. I'm so excited. It's the teacher in me. I love vocabulary. I love new words. All right, so this is not going to be in alphabetical order because I'm not that crazy. And I'm actually doing stocks with my students. My seniors were going into personal finance, so I'm probably going to send them over to this video at some point as well. They're graduating and they already know about this channel, so hi y'all. Let's get into it. I am getting help from Miss B Helpful, who works for this really great, cool company who has really been helping me build personal finance into my students' lives to kind of teach them all these things. So shout out to her and shout out to her really awesome company that I've linked in the description box and also shout it out right here. All right, so the first term we're going to talk about is rate of return. It is also called the rate of investment or return on investment, ROI, which you've seen pretty much everywhere essentially if you're into the stock market world or trying to get into the stock market world. And all that means in layman's terms is how much money you've earned or how much money you've lost compared to how much money you've invested. So for example, if you bought, let's say, Apple stock for $5, which yeah, right. You bought Apple stock for $5 and it's now selling for $20. You have essentially made $15 on each share that you have purchased, as opposed to if it's like $2.50, then you've lost $2.50 on each share that you have purchased. So that is called the ROI. The next term is security. And no, I don't know what's going on with my hair today. Security. What security means, it's pretty much any asset that you can buy in a financial market. So stocks, bonds, mutual funds, index funds, all those things. Security. The next term is bond, like James Bond. All right, so a bond is a security, like I mentioned in the term previous, like literally 2 seconds ago. And what a bond is when you, the investor, you invest in a company or in the government and you give them a lump sum of money. It could be $20, it could be $2,000, whatever it is, and you agree upon, or they agree upon, a specific amount of interest that money will gain, and you get your money back and the interest earned on your maturity date. So that is why a lot of times people used to give bonds to kids. I know I sold my bonds when I bought my first place last year, and it was really a nice chunk of change that my parents had from when I was a kid. So let's say they bought a $25 bond as a child and it was a 30-year maturation date. That means in 30 years I would get back that $25 and whatever interest has been gained over the 30 years. Next term we're going to be talking about is capital gain. I love talking about capital gains. Capital gains are the profits that you have earned subtracting what you actually paid on your security or your whatever stock or bond that you bought. So like I said, if you spend $25 or I think I said $5 on an Apple stock and it's now going for $20, your capital gain would be $15 on that particular share. So capital gains are a definite good thing. It's money. Extra money. The next term is diversification. I don't know if that's too difficult to understand because it comes from the word diversify and it means the exact same thing as the actual term diversify. So diversification is when you sprinkle your money in all different areas of the financial world and it kind of minimizes your risk, right? So like I said in many stock videos previously, you don't want to have all your money in one particular stock. You don't want to have all your money in stocks, right? You want to look into different areas, 401ks, you want to look into IRAs, you want to look into mutual funds, you want to look into index funds, you want to look into all types of things, ETFs, things like that. I prefer index funds because it kind of helps diversify my portfolio in general. But diversification is really crucial and key in order to make sure that you're minimizing your risk and you're kind of having your hand in all the little financial pockets of the stock market world. Dividends. I did mention dividends in my first Stock Tip Tuesday video, which if you have not seen, I'll link right above here. Dividends are the money that a company or corporation will pay you based off the profits that they have earned, you as a shareholder, and those are usually paid quarterly. Some companies will pay annually. It really depends on the company setup, but dividend is a good thing because it means that one, the company is profitable, and two, you're getting money for being an investor in a profitable company. So you like dividends. We like dividends. We like capital gains. Dow Jones. I remember when I figured out what Dow Jones was, how excited I was, because that's all you ever hear on the news and everything. Dow Jones, NASDAQ, all that stuff, right? So Dow Jones is an index, and it tracks or covers, or no, it includes the top 30 or the best 30 like profitably sound, stable companies, and it really just tracks how well those 30 companies are doing. And the reason people panic when they're like, the Dow Jones is down, because it's the average of those 30 companies, their profit or their money, their stock is declining. So it usually sends people into a tizzy when the Dow Jones is down, but that's all it is. It's just 30 really huge corporations that are usually financially sound that the Dow Jones tracks or covers. Index funds. So I've mentioned index funds a little earlier in this video, and I did a whole video on index funds versus mutual funds. If you haven't seen that one, you know what to do. So an index fund is a low fee portfolio for companies, and it tracks or mimics the stock market. So you don't invest in individual stocks when you're investing in index funds. There are so many different types of index funds that you can invest in that cover all different types of things. A really big popular one is the S&P 500, right? And you can kind of play around with like Apple and CVS and all these other and Walmart. All these companies fall into different sorts of index funds. So it's really important that you research the index funds that you want to get into, because especially during this time, some index funds are going to do better than others. IPO. This term is thrown around all over Silicon Valley, and which trickles its way down to us regular folk not in Silicon Valley. So IPO just stands for Initial Public Offering, and all it means is the first time that a company sells shares in its company on the stock market, right? So when Facebook launched its IPO, it was like a big thing. When Uber launched its IPO, all these companies launching, it's just they're making their company public. The public, now have access to buy shares in that company. You are now a part of the company. Market capitalization is the value of a company, evaluation essentially. And if you watch Shark Tank, you'll know what I'm talking about. So market capitalization, what they do is they take the current price or the current cost of one share and they multiply it by the amount of outstanding shares that exist, and that is how they equate the evaluation of the company. So that is called market capitalization. Mutual fund. So mutual fund, much like an index fund, is a conglomerate of stocks, and they sell those stocks as one particular unit. A mutual fund is more active investment, so you usually you have a stockbroker or an agent that's watching the market, and they're selling these stocks out as a unit, and they're buying these stocks as a unit for you, because you're trying to not ride the wave of the stock market just like an index fund, but you're trying to outperform the stock market. So you're trying to make money based off of the dips and peaks of the stock market, which is why mutual funds can go like day trading like every hour, every half hour. It moves really quickly, and I just don't have, my heart couldn't take mutual funds, but that is what a mutual fund is, and that is how it differs from an index fund. NASDAQ, to my understanding, is the second largest, which makes me really excited because I live in the city with the largest. But NASDAQ is the second largest stock market exchange in the world, followed by the NYSE, which is the New York Stock Exchange, which is what Wall Street is all about, and that's where all the trading and the big bucks and trillions of dollars are in the atmosphere. So NASDAQ is the second, followed by the NYSE, which is the first, and again stands for the New York Stock Exchange. The S&P 500 is 500 companies, or an index of 500 companies based off their industry and their size, and some other like factors kind of decide who goes into the S&P 500, but it pretty much gives you a wide variety or spectrum of how the stock market is going. So that is why so many people invest in the S&P 500 when they do index funds, because it's a big one. It's really indicative of like how the world is doing money wise. Yeah, that is what it is. It's indicative of how the world is doing money wise. So S&P 500 is very crucial. And the last term, because I realized I never really defined it, is stock. Stock. What is a stock? Stock is just a piece of a company, one little piece of a company that you purchase and you can sell and trade and gain profit off of those buying and selling moments, and you own a little piece of the company. So if a company has 1 billion shares, which, if a company has 1 billion shares and you buy one stock, you have 1 out of 1 billion shares of that company. 1 out of 1 billion percent, if that makes sense. And that is it. I hope this video was helpful for you. I hope that you spread the knowledge, and I hope you come back for the next video. Bye.